Okay, so here we have a typical CFA Level 1 question regarding risk-free rate of interest and stock prices. So we're talking here about a decrease in the risk-free rate of interest. What effect will that have? Will that increase stock prices? Will that decrease stock prices? Or finally, will that have no influence on stock prices whatsoever? So take a moment to think about it. The way to really answer this question is to use this handy little formula we have, which is basically the Gordon growth model, dividend discount model, however you want to think about it. So what we have here is P naught. This is symbolic of stock prices. P naught is the price at time zero, so the price today. D1 is the upcoming dividend, so the dividend in period one. So not the dividend that just happened, but the upcoming dividend. R is the risk-free rate of interest, and G is the growth rate of the firm. So what's going to happen is if we end up decreasing the risk-free rate, we're going to make R smaller. So R goes down. So R becomes smaller. So what's going to happen as this beginning part of our formula goes down, we're going to be subtracting G from a smaller and smaller number. So say we have 15 minus a growth rate of 5, and we shrink this to 10 minus 5. You can see that this is 10, this is 5. We're making our denominator smaller. As the denominator gets smaller, that's another way of making the quotient go up. So risk-free rate is going down. The dividend is staying the same. That's the numerator. The denominator is getting smaller, so stock prices are increasing. So another way that we can talk about this that you sometimes hear is we can say stock prices and interest rates have a negative correlation. So that means when one goes up, the other one goes down, and vice versa. So this model, the dividend discount model, the Gordon growth model, helps explain why that happens.